Hello traders, you are welcome back to the Forex Geek channel, and in this video we are going to break down the ICT new day opening gap. All right, it's a key smart money concept that can give you a huge edge in understanding daily price action. Now let us start with the definition. Okay, the new day opening gap is simply the difference. All right, it's simply the difference between where the market closed yesterday and where it opens today. Okay, so this gap forms naturally because markets don't always open at the exact same level that they close. All right, so um, this can be due to institutional order flow, liquidity shifts, or overnight imbalances. Okay, now why does this matter? The ICT New Day opening gap acts as an important reference point. Price often uses this gap as a magnet. Okay, look for a good example to use. For example, you can see this was where price closed. This was where that day closed, and this was where the next day opened. So we had a gap here. All right. So it serves as an important reference point. Okay. Institutions are aware of this, and understanding how it works give you the same insight that they rely on, because price uses this gap as a magnet. It tends to revisit it, rebalance through it, and react strongly around it during the trading session. So here's how you can identify it. The first step is to mark the closing price of the previous trading day. The second step is to mark the opening price of the new day. The space between these two prices is your new day opening gap. Okay, so once you have marked it, you keep it on your chart as a key zone for the current day's trading. All right, so how does price usually react to this? If the market opens higher than yesterday's close, if the market opens higher than yesterday's close, you have a gap beneath price. Okay, very often the market will retrace downward to rebalance that zone before continuing in its overall direction. So let's look for an example of the market opening higher, because in this case the market opened lower. All right, so you can see this is an example of the market opening higher. This was the close, this was the open. Right, so the market will likely retrace downward to rebalance the zone, and you can see that we had a rebalancing actually. But if the market opens lower, the gap sits above price and it may climb back into that zone before resuming lower. So this doesn't mean every single gap gets filled immediately, okay? But more often than not, these gaps act like magnets for liquidity. Price tends to respect them. And if you combine this knowledge with market structure, you can anticipate the most likely reaction. For example, if your higher time frame structure is bullish, okay, and the new day opening gap is below price, you can watch for the market to dip into that gap before pushing higher. On the other hand, if structure is bearish and the gap forms above price, it may retest that gap before continuing down. All right. So the ICT new day opening gap becomes even more powerful when used alongside other concepts like order blocks, fair value gaps, and liquidity pools. All right. When multiple confluences line up around the daily opening gap, it increases the probability of a strong reaction. Now, to recap, the new day opening gap is the difference between yesterday's close and today's open. Yesterday's close and today's open. It highlights areas of imbalance and liquidity. Price often revisits or reacts to these zones during the day. Okay, and then combining the gap with structure and other ICT concepts makes it more effective. Remember that the opening day gap is not just a standalone strategy. Okay, of course you have to combine it with market structure, combine it with other ICT concepts, and to get a more refined strategy, to get a better working strategy. Okay, and of course you also have to inculcate risk management practices. All right. For example, if you want to use the gaps, of course, as area of liquidity to enter a trade in the direction of the prevailing trend, you should have clear targets for your stop losses and clear targets for your take profits as well. And then I'll recommend using risk to reward ratios of minimum of 1:2. Okay, always have good risk to reward ratios, and make sure that you don't risk more than 1 to 2% of your account balance per trade. Okay, unless if you are an aggressive trader. Well, if you're an aggressive trader and you want to risk 10%, you are on your own. But just always put in mind that no strategy guarantees 100% profit. So there are times when you're going to have losses and there are times when you're going to have gains. Okay, but you should ask yourself this question: when you lose, shouldn't you lose a little? And when you win, shouldn't you win big? So in that case, you ought to be risking small percentage and targeting bigger than what you risk. All right. So even if you have equal number of wins and losses, you're still going to be on the winning side. Imagine if you are risking 10 pips to always make 30 pips. Even if you lose 3 consecutive trades, you would have lost just 30 pips. If you win the next 3 consecutive trades, you would have won 90 pips. When you subtract that 30 pips from that 90 pips, you'll still be in a profit of 60 pips. Okay, so you see the benefit. Now, by marking these your open day gap, new day opening gap on your charts every single day, you start to notice just how often the market respects this level. It's a simple yet powerful tool for traders who want to better understand institutional price action. So if this breakdown of the ICT new day opening gap helps you, make sure to like the video and subscribe for more smart money concept guides. See you in the next one.